realize.
Yeah. Hi, everyone. We will just wait for 20 seconds for participants to join, and then we will start. I think we can start. First of all, sorry for being a little late. Uh, uh, Hello and very good evening, and thank you so much for joining today's Global Compounders webinar. Global Compounders Fund was launched around 20 months back, and the performance has been very healthy, both in terms of absolute return and relative return. We launched the fund because we could clearly see that there is a need for a HNI client to diversify his investment globally, but he or she does not had many options available to him or her. Plus, we also decided to launch the fund because people of Arindam's and Javid's caliber decided to join Marcellus and manage the fund. However, there were operational challenges and it was not easy for resident Indian to invest globally. But the scenario has changed a lot in last couple of months because government and GIFT City regulator have announced slew of measures that has made global investing simple and easy. In today's call, we will cover the changes introduced by the government and GIFT City regulator. We will touch upon performance of the fund, recent trends in the global market, and what to expect going forward. To discuss all of this, we have Arindam and Jabir with me. Arindam is the fund manager and Jabir heads the research for our global fund. Thanks, Jabir. So I will quickly take all of you through the changes that has occurred in last couple of months that has made investing globally simple. The first change was announced, or that I'm touching upon, was announced in the recently concluded budget, where Government of India announced lowering of long-term capital gain on global equities from 20% with indexation to 12.5%. Basically, LTCG on global equity is at par with LTCG on domestic equity. Now, it's a big positive, especially for our fund, because we expect our churn to be on the lower side, and large part of capital gain that we expect is to be of long term in nature. So it's a big positive that government has introduced. Second change announced in the recent budget was that TCS, tax collected at source, can now be set off against TDS, TDS that is deducted for salaried people. So basically, whenever a person wants to transfer money through LRS route, 20% TCS is collected. Now, just to give a simple example, I want to transfer $100,000 or 80 lakh. Then I should have 96 lakh rupee in my account. Bank will remit 80 lakh in dollars, worth of dollars, 80 lakh worth of dollars, and deposit 20% of 80 lakh, which is basically 16 lakh with Government of India against my PAN. Earlier, there was no clarity if salaried person like me could set off the TCS, 20% that has been deducted against the TDS on my salary. But now it has been made crystal clear by the FM. It's a big positive move because the hit on my cash flow has now been reduced substantially. I can the TCS that has been deducted, I can give the proof to my employer, and they will set it off against the monthly TDS, against the salary. So that's a big positive for us, for investors investing globally, especially salaried class. The third change is that RBI recently allowed resident Indians to open foreign currency account in GIFT City. Earlier, it was very, very difficult for most of the resident Indians to open and operate dollar account. It was a major concern for many investors. And just to give you a simple example of the problem, before this announcement, a resident Indian would have opened account with Marcellus Global Compounders and would have transferred $150,000 USD in Marcellus pool account in GIFT City. He would have done so because client would not have his or her own foreign bank account. Suppose after 3 years, client wants to redeem and does not have a foreign bank account at that point of time as well, because he or she could not manage to open the account. they would be forced to convert the dollar back into INR and receive that money in his or her personal Indian bank account. But now with RBI clearing dollar account, client can open it in Gift City. And when they redeem, they can park that dollar money in dollar in Gift City. And they can in future, in 1 month, 3 months, 6 months, they can again redeploy back in dollars. So it makes life very simple, very easy for investor. The fourth change that was announced was by the Gift City regulator, IFSCA. They announced accredited investor regime, whereby an accredited investor does not have to meet the minimum investment criteria of US dollar $150,000. The accredited investor has been defined as a person who meets any one of the two criteria. His or her gross annual income last year should be more than $200,000, which is basically 160, 170, 1.6, 1.7 crore, or the net asset owned by them should be more than US dollar 1 million, and 50% of it should be in financial assets. If anyone is an accredited investor, they can start their journey in Gift City at a lower amount. So, for example, if they want to invest with us, they can start with US dollar $25,000 instead of USD $150,000. So again, it's a great move. And as recently as last week, Gift City regulator has come out with a consultation paper, which proposes to reduce minimum ticket size of investment routed through Gift City to US dollar 75,000 from $150,000, which is the current minimum threshold. Now, we expect the change to be approved and implemented in next couple of months. Lowering of minimum ticket size to US dollar 75,000 or roughly INR 64, 65 lakh will open the opportunity to invest globally for many more resident Indians. Again, it's a great move. And we hope it will be implemented very soon. We believe all the changes that we have discussed has made investing globally simple. Many times in the past, we have discussed the reason to diversify and invest portion of your savings globally. Country diversification or aligning one's income and expense is fairly easy to understand. However, many of us does not appreciate enough the fact that combination of India and US market offer better returns with lower risk. Now, I will request my colleague JB to help us understand how combination of Indian and US market reduce volatility and offer little better returns compared to investing 100% in Indian market. So Jabir, if you can take that. Before that, we can quickly show the performance number of GCP. This is GCP live performance till last month. 1 month, 3 months, 6 months, 1 year, and since inception. Since inception, we have delivered 31.41% dollar return compared to the benchmark 23.28%. As I mentioned in my initial comment, both absolute and relative returns has been very, very healthy. Same is in INR denominated returns as well. The fund has performed exceptionally well since inception and almost in all time frames. Now, coming back to Jabir, if you can please help us understand why combination of Indian and US market helps to reduce volatility with better returns.
Thank you, Nitesh. So, starting point on understanding this would be around correlation. Now, correlation is a statistical concept, but to simplify it, over a long period of time, India return and US returns tend to be quite similar if you adjust for currency. However, over shorter durations of time, so say 1 month, 3 months, 6 months, 1 year, these returns can vary. So these variances in shorter duration returns means that correlation between India and the US equity markets is not perfect. There will be periods in time where one does better, where the other does better. Now, in reality, where this shows up is when there are country-specific events. So in India, we had, over the last decade, we had an IL&FS crisis, we had demonetization. In 2011, we had an interest rate hike and a growth slowdown. All of these caused the India market to correct. But these factors didn't have any real effect on the US market. So you saw this period where India was down 10%, 5%, 25%. And in all of these periods, the US was significantly up. Similarly, there have been US specific events. Right? The 22 interest rate hike cycle in the US plus the Russia-Ukraine war significantly impacted the US equity market. It didn't have that sort of effect in India. Similarly, the US-China trade war in 2018 or the dot-com bust of the early 2000s, all of these caused double-digit drawdowns in the US market, while India was flat or positive or even up 10%. So this sort of in a way shows you that if you're invested in one, you live through the volatility of that one, and you don't benefit from the opportunities of the other. Now, one thing to notice here is that when it's global events, so something like COVID, something like the global financial crisis, there India tends to do worse. Part of the reason behind this is the fact that rupee tends to depreciate in such periods. So in currency adjusted terms, the India market looks much worse, and there is relative stability in the US market. Right? So the dollar tends to appreciate in such period of crisis. Right? What this means practically is that if you're investing equally in both markets consistently over a long period of time, you're benefiting from averaging opportunities in both markets. And what that means is that your combined return is actually slightly better than either of the markets. Right? This chart on the right sort of illustrates this. If you invested 100 rupees every year in both markets for the last 20 years versus investing it only in India, you would be better off today if you had actually done both. And the other benefit that shows up from this is that your drawdowns tend to be shallower if you're there in both. Now, back to you, Nitesh.
I would probably add a couple of points here, JB. So one thing is, the drawdown, the significance of drawdown is probably, we don't appreciate it that much. Just to give an example, if suppose a market is down 25% versus another market is down 40. So if you can go back to the previous slide. Right. So, for example, global financial crisis just took time August to December 2008. Now, they optically looks, just difference is 15, 16%, right? In terms of it was down 25, another is down 42. But if you think of it in this way that, you invested 100 rupees, you went down to 75, and if you are in S&P, so you have to get back around 33% to get back to that 100, right? So 75 to 100 is 33%. But at the same time, if you're just in the Indian market, you are down 42, so your 100 becomes 58. Now to get back to that 100, right? The you have to actually get 70 to 75% of return. Now that is something that drawdown causes. It is not just a starting point or end point. The path is actually quite important from that standpoint. So you can mitigate that kind of drawdowns. Of course, there are behavioral aspect. You kind of it is traumatic when you see your money going down, your wealth going down significantly. And the second thing, I mean, if you can go back to the next slide, Jabir. The right chart that Jaivid just explained, it was actually suggested by one of our clients. He actually mentioned that, I'm a long-term investor. I'm not actually the money that I'm putting in today. I'm not going to look at it after, not before 18, 19, 20 years. Now, in that case, does it really matter? If I'm investing in one market or if I'm investing in both the markets, given that, the end return is actually very similar. So as part of that, just to answer him, actually, we thought about coming up with this, that you put every year, you are putting 100 rupees. Either you put it in the Indian market, you do it for last 19 years, as JB said, or you're splitting it every year, 50-50, right? Every year you assess that, where I am and do a natural rebalancing, right? So even though the total numbers, in the endpoint, starting point or end point is not that different in terms of the CAGR numbers that you see on the left side, the end result, like the amount of wealth that you create, over that 19-20 years period, that is actually quite different. 20-25% is significantly different. Back to Nitesh.
No, absolutely. I think that's the magic of compounding. If you can just go one slide back. I think over here, if I understood correctly, Arindam, just to be very clear, 100 rupee invested every year in the chart on the right hand side. I think x-axis is should be reversed. 100 rupee invested every year only in Indian equity would become 8,572.
Yes.
100 rupee invested in combination of both the markets, as US market and Indian market, it would become 10,340.
Right, exactly. Yeah, you're right. So the chart actually, yeah, we should have, I mean, the year zero should be your starting point. It is
Yes.
actually misreading. Yeah.
No, absolutely.
Sorry
This,
about that.
yeah, no, fair enough. I think these are really powerful chart. These are really powerful chart which clearly shows the benefit of a diversification, which helps to give little better returns with very low low volatility. No, fair enough. No, just to touch upon volatility, last month July was very eventful month where we saw a very high level of volatility in US market. If you can touch upon what led to it, Arindam, and how did our portfolio perform in that volatility?
Yes, that's a great question. I mean, one of the reasons that you thought about doing this webinar in short notice because we're getting a lot of questions, especially after the market sold off, especially the popular stocks, right, in the month of July. So if you can recall, I mean, we are since we have launched the fund, in fact, since end of 2022, the market has been actually quite narrow. Okay. So the market quite narrow. If you go to the next slide, Jaybir. Yeah. So the market has been actually quite narrow. So when I say narrow, that means so this is a chart that we found in internet, published by Apollo. So the slide that the chart that you see on the left hand side, that basically tells you the number of stocks within S&P 500 that has delivered better returns in last 1 year compared to the broad index. Okay. Now, as you can see, going back to 1980s, we have never seen this kind of concentrated market, right? Um, so, Jaybir, if you can go back to the slide, the earlier one, yeah. So that, to some extent, I mean, when you get into a situation when the market is too concentrated, just relying on few, generals or few handful of stocks, um, there is typically something what we call momentum reversal. So that we saw, the big mega caps kind of selling off, the most popular stocks getting sold off. So that was number one. And then secondly, when we started this month, the jobs data that came in the US that was actually lower than expected. That's number two. And then of course BOJ, they hiked the interest rate, and after years of zero interest rate policy, that's kind of shocker. And of course, the popular trade, what is called Ian carry trade, in a very simplistic term, these both of these markets, Japan and the US, they're both developed markets. Japan gives you money at 0% rate, and you can actually invest that money in US at 5-6%. So kind of both considered less risky markets. So there's a clear arbitrage. That trade has been very popular, especially when US started to raise the interest rate. So that trade started to unwind because all of a sudden Bank of Japan started to increase the interest rate, right? Now again, there have been many opinions like how much of that has been already done, etc., etc. So that was a kind of that created some volatility. We are not expert on that. In fact, the market has actually come back to almost similar levels since this came up. But I think the real thing that might play out over next 12 to 24 months is the first thing that the kind of reversal of the popular stock, getting a beat up continuously vis-a-vis the laggards in the market. Again, can you go back to the next one? Yes. So again, just to illustrate that with data, so since we have launched, the broad market return has been around 47%, okay, 22%, 23% CAGR. And the top, the Magnificent Seven that we talk about, that has contributed around 24%. Basically, half of that has been contributed by this Magnificent Seven. If you look at our portfolio, thankfully, I shouldn't say thankfully, but the contribution from these big, the most popular stocks have been actually quite less, right? So we have been much more on the stock picking side. It actually worked pretty well for us. Can you go next? The chart where you're showing the valuations. Yeah. Now the point that is important, I think, to understand here, at the index level, when you're looking at S&P 500 or Nasdaq, etc., we always talk about the questions typically we get is that the market is too pricey, which is fair. I mean, if you look at the longer term median, we are taking last 20-25 years of data. The median S&P P is around 15 and a half. Now it is trading at 19.6. But if you just look into the different part of the market, so for simplification, what we did is we took the S&P midcap index, which is basically the 400 stocks just after the S&P 500, right? So up the 500 large stocks, and then we look into the other part of the market, next 400 large stocks. You take that index, and if you look at the valuation that it is trading at is 14 and a half. Now that is actually below 15, 15 times P that it used to trade at over a longer period of time. So that is where we think the opportunity exists. And it is not that the mid caps don't grow. In fact, if you look at the table that we have put out here, over a long period of time, mid caps tend to grow similar at some very similar level to what the large cap does. Now, there is a reason that it happened, but for investors in GCP, just wanted to ensure that we're much more mid cap oriented. Our positioning has always been, we are not too much into the mega caps. Again, going back to the previous slide, if you look at our allocation, uh, yeah, so if you look at our allocation, uh, on the right side, you see the S&P 500. Around 55% of S&P 500 is the stocks which we call mega caps, the stocks which have market cap more than $250 billion. If you look at GCP, it is around 30-70. 30% is in that more than 250 billion. The rest is in the other part of the market. And on the right side, it actually showed up in the numbers, in the return numbers. So if you see, GCP actually did reasonably well during that volatile period. It was actually up a couple of percent. S&P was down couple. In fact, the Nasdaq, I mean, again, that has the most popular stock, that was down 6-7%, right? So that is where we are. Nitesh, to your question, of course, there has been a period of volatility, but when I look at how we have positioned our portfolio, I think it's quite balanced, and we expect it to, continue deliver alpha over longer period of time.
So in a nutshell, Arindam, last month when markets were pretty volatile, our portfolio was stable.
Right.
And one of the reasons, as you mentioned, we are more heavy on mid cap and our weightage on Magnificent Seven or tech stocks has been pretty low.
Right.
And yet, we have been able to outperform. And when market corrected, our portfolio was did exceptionally well, compared to the overall benchmark. Fair
That's
enough.
right.
Now to touch upon the valuation part, given that last couple of years, obviously our portfolio has done well, but market has also done reasonably well. As a layman and as a investor who is looking to invest, is this a good time, or its markets are heated, or should we wait? What's the view on valuation for a new investor? Should he invest, or it's
Yes. I, I think again, we can tie it back to this slide. So there are pockets where the valuation is not atrocious, right? And that is what we are trying to do. So I think it is actually turning out to be a good time to be in active management rather than just buying passive funds, etc. Because the stock selection, etc., should play a bigger role if I'm looking at the next 24 months kind of horizon. I think there is a good chance that if you're actually finding a lot of pockets where there is value. Okay, and again, you have to be patient because they don't start working overnight. But if you're patient enough and let them work, we think there is a lot of opportunity there. In fact, what we did, in last few months, we actually took down the relative valuation of our portfolio. Okay, given that the portfolio is getting a little bit more expensive that we are comfortable with. So if you look at it, the relative valuation of our portfolio at the beginning of July was around 1.5 times that of the index. We did some changes in the portfolio, and we brought it down to 1.4%, 1.4 times of index multiple, and we are talking about EV/EBITDA multiple here on a relative basis. One simple way to look at it, the portfolio that we have, the stocks that we have, they're supposed to compound at around mid-teens. Okay, so 13 to 15, 14 to 16, that is the cohort. S&P typically the total return is around 9 to 10, right? 7.5% of EPS growth. Rest is from your dividend. Uh, so if I just simplistically look at PEG ratio, and there is a lot of debate that can be done how useful this ratio is, but we try to make sure that the PEG, right, of our portfolio versus that of market is at a palatable level. We are not too much overshooting that. So that is something we religiously try to follow. In that sense, I would say that the portfolio, given its potential, is still a good time in our view if you have a longer time horizon in your mind.
So, Arina, basically, the portfolio has outperformed the benchmark by 9%. And despite that, on relative basis, today it is cheaper than what it was previously.
That is right.
Compared to benchmark. So,
Yes,
if you
that
can
is
just
right.
help us understand how you went about it, how you did it. Did you make changes in the portfolio that led to this? You included more companies which had higher earnings expectation, or you replaced by companies which were available at cheaper valuation?
Combination of both. For example, when we started the portfolio, one of our biggest stocks, and in fact, it is one of our favorite stocks of all time, probably is Costco. So it was a 8 to 10%. I mean, depending on the time you're looking at, so 8 to 10% of the portfolio it used to be. We sold it off actually last month. The reason being, I mean, we made actually a lot of money into it. I mean, we started buying it around at 400, we sold it around 840, right? So it has been a good stock, but at the same time, even though we acknowledge the strength of the franchisee, I mean, it's a deeply moated company, but the valuation went through a position, in a kind of situation that we had to trim it off. Same thing happened with Apple. We did the same thing. It again the valuation we're not comfortable with. And at the same time, we are seeing that there are opportunities. For example, when we sold Apple, we actually bought something called American Tower, right? So American Tower is a tower company, is very well managed, but they got hammered because of the interest rate hike, right? So we're kind of looking for this kind of opportunity where there is mispricing, and that is what we are trying to capitalize on. Even going forward, also we would be doing the same. In fact, another company I mentioned again, one of our favorite companies, Armis. When we started, it was the second or third largest position. We trimmed it last year, I think middle of last year, given again the valuation concerns, the chance of consumer slowdown. So we trimmed it. So we keep on doing these things, to make sure that we are kind of responsible with the overall valuation of the portfolio. At the same time, it is not that we are replacing those companies with a underperformer kind of subpar asset. The asset that we're buying, that should be also at least as good or kind of similar return potential going forward.
Got it. Fair enough. I will request all the participants, if you have any queries, please type it on the Q&A box, which is at the bottom of your screen. Please type it, and we will try to answer as many of them as possible. Arindam, you mentioned that return has been very narrow in last 2 years. Handful of companies, magnificent as we call it, has driven a bulk of it. And you not owning 5 out of the 7, and despite having very low allocation to them, how did you manage to outperform?
Right. I mean, that is, I think, the beauty of I would say US market is a very deep market. So, even though we always talk about say 15, 20 stocks, but if you just look down under, you'll find a lot of great quality companies. Many of them are not spoken about, which is actually great. That gives you opportunity to not only just compound the earnings, but at the same time, when they become more well known, you get an additional bit of from valuation too. But the point is, here is that even if you think about like S&P 500, just a 500 set of companies, the 20% is outperforming means there are 100 stocks actually who are doing well. right? And we are not going to, the portfolio is a very concentrated portfolio. If you look at any global portfolio, they will have 60, 70 stocks, right? We are doing just 25 to 30. The goal is, like we are in those right 30. So there is a, even though it is a narrow market, our stock selection procedure, the way you do research, that, that makes sure that we're in the right 25 to 30, even if the market is narrow.
Got it. In fact, Mr. Dharan Chadda has asked a question. What would the return have been if you had put greater weight on Magnificent Seven?
Yeah, that's a great question. I mean, actually, Magnificent Seven, I mean, if we had, say, okay, let me answer it this way. So Nvidia alone has been a drag of around probably 7 to 8 points, right? The Magnificent Seven has been a drag on the portfolio. If I just compare the S&P 500, the weights they have versus what we had, they have been a drag of around 14 or 15 points. Okay, so you can add, given that it's a 2-year-old portfolio almost, you can add 7 points almost roughly. So the earning the it had been much better for sure. But again, I mean, it's a perfect hindsight kind of scenario. And to be very honest, I mean, it is not that we don't like those companies. We missed few, but that will be, that is the practicality of how we invest. You'll miss few, you'll probably invest in few great ones too.
I think it will be almost impossible to get hold of all the 10 baggers. Idea is, we have few and we don't make blunders. And plus, Arindam, if you can help us understand, what is the expectation, what as an investor, I should expect in terms of return over a 4 to 5, 6 year cycle. What is the thought process basis which you manage this fund?
Right. So the companies that you're looking at, if I look at their historical performance, for example, last 5 year, 10 year, 7 year, 10 year, they have compounded in dollar terms. Every number I'm talking here is in dollar terms. Has compounded around 17 to 20%, somewhere between that. That is the cohort in any time frame you look at, any 5 year rolling time frame you look at. Um, our uh, our assumption is that they will at least be doing around 13 to 15 fundamental level. Just a little bit conservative, right? I mean, as the companies mature, the base is typically larger, so even their moats are stronger, but optically your growth will taper off to some extent. So 13 to 15%. Then the portfolio allocation tools, the discipline that we maintain around valuation, the style, movement, etc. That should add around couple of percent. So that is basically my job as a portfolio manager. You select the stock. Jaibir and I kind of try to make sure that we are selecting the right stock, getting it to the 13 to 15. And the next leg is adding the additional juice on top of it. So that is in absolute term. Having said that, it is a long only fund. So you have to remember that, if there is a major market correction, it is not that our stocks will be spared. So that is for sure. On relative side, if you think about, if you just compare S&P, S&P does 9 to 10%, right? So putting this all together, we are basically at a gross level, we are looking at around, say, 15, 16% kind of return. On a relative basis, it will be 6 to 7%, 6 to 7 gross level. Now you think about the drag from fees and the churn related taxes. So we are looking at around basically, in dollar terms, 3 to 4 points of alpha over S&P, and probably in absolute term, we are looking at dollar level, 13 to 14% CAGR. If you bring it back to INR, probably you're looking at a 16, 17. If we think the dollar keeps on appreciating at 2 to 3 points every year.
Got it. One of the questions that we have, and this is pretty interesting, you had mentioned that large cap is expensive. Tech stocks have become very expensive. Do you see any similarity with during dot-com bubble? Are we in any such bubble?
Look, there are some.
Yeah.
Yeah. I mean, there's some similarity, but again, there is, the companies, given that they have seen that cycle, probably they're better prepared. But again, the cycles are never going to be same, but it rhymes at times. Now, given that it's tech and Jaibir actually has seen these cycles, experienced it on his own, so I leave it to him to give his expert comment.
Uh, see, if you look at it purely as a tech hype cycle, then yes, it's similar to what the dot-com bubble was. But there's a few very large differences. So the first is the dot-com bubble had a lot of leverage. There was a lot of infrastructure built out by telecom companies, by cable providers around, and a lot of debt associated with it. This cycle doesn't have any of that. A lot of the capex that's going in is being done by mega cap companies like Microsoft or Google or Meta or Amazon, who have massive balance sheets to do this and who don't really have any real leverage that they need to take. They're not even even after all they spend, they're still free cash flow positive. The other point is that unlike, say, that cycle where there was this rash of IPOs, there were so many sort of frivolous companies which got listed. AI hasn't seen any of that. We saw general tech cycle similar to .com in terms of IPOs in 2021, but we haven't really seen any of that when it comes to AI. And the third would be that the technology advantage that somebody like an NVIDIA has in this cycle versus what, say, a Cisco had in that cycle is quite different. That we expect NVIDIA will see increased competitive pressure, will see potentially some erosion in margins if the cycle turns. But we don't expect it to get commoditized. That sort of risk isn't really there. So that in terms of hype, yeah, it might be similar, but a lot of the financial implications of it have been quite different.
Got it. Makes sense. Another question that we have is, and then you mentioned that there will be convergence in large cap and mid cap valuation. Why do you say so? And also why investor bet big on large cap in last couple of years?
Yes, so look, I mean, there is a very rational reason. Like if you're mid caps, there are two things. If you invest in mid caps or invest in small cap with the hope that they'll be delivering you better returns. If you look at last 5, 6, 7, 8, 5 years actually, from 2019 onwards, the large caps, in fact, that was dominated by the select few of the names that you talk about. They started to deliver as good numbers or even better than some of the smaller caps, right? So if that is the case, then of course the question comes back to the fact that why do you want to take that additional risk and invest in companies which are lower in smaller in size? It has increased risk, right? Now, even in last 18 to 24 months, since the rate hike started, the economy got pressured. That is for sure. Now, when the economy gets pressured, the small and mid cap companies they feel the punch much more because they are more economically sensitive, right? Uh, as a natural inclination, the investors are typically looking for. We are always looking for where you find earning certainty. The companies that can actually deliver you numbers, that can actually deliver you growth. And that is where this, the Magnificent Seven, it is not actually Magnificent Seven. Even when you think about Eli Lilly, they came up with their, obesity drug, right? GLP-1, etc. The Costco's of the world, where you can see that, people are actually going to shop more and more in Costco's. It is not just take. We saw a bunch of companies which can actually float around delivering earnings growth comfortably. We flocked in there. Now, coming back to your question, like why you think that the convergence might happen, etc. This AI spend, whatever is going through now, at some point of time, you have to monetize it, and to monetize it, you need the enterprise to spend money on them, right? So if the economy doesn't pick up at some point of time, they're not going to spend on AI because they don't make money. How will they spend? How will they spend more? The initial pickup, they'll not spend more. And in that case, what is typically, how this cycle might wrap up is suppose the economy doesn't pick up and you get a sudden growth shock because these stocks are not cheap, right? So that the margin of safety is very low. So either it can play in that way, Or the other thing can be that the economy gradually picks up once the interest rate cut starts, the consumer becomes less levered, they can start spending a little more, the enterprises can start spending a little more. So in that case, what we will see probably is that, suddenly the investor base will start seeing that, okay, we are seeing earnings growth coming in this part of the cohort as well. And if that happens, typically you will see the valuations kind of converging because the growth differential will not be that much, right? So those are the bets. In any case, I mean, I don't know what the market is going to do in next 3, 6, 9, 12 months, but on a relative basis, probably if we're looking at 12 to 24 months, I mean, there's a decent chance that we might find this convergence might be happening. The chance is probably a little higher.
Got it. Makes sense. Preet is asking, can you offer any commentary on what you look for in capital allocation for the companies in GCP? And GCP companies which has been buying back shares. So which practically shows they're undervalued. So any thoughts, any comments, any data on that?
Sure. Jabir, feel free to jump in. So look, I mean, thinking about capital allocation, there are typically four ways to allocate capital, simplistically. You invest in organic growth, you repay your debt, you buy back your shares, or you go and acquire some company, right? Simplistically, these are the four ways to deploy your cash. Sorry, fifth is paying dividends. If you're not buying back, you can pay dividends also. Broadly, I mean, look, I mean, this concept of buyback, it has been actually become very popular. Now, not every company that is doing buyback is actually making money for shareholders. There are very select few. I mean, for every AutoZone or Aurelis of the world, which are buying back massively, they have been actually great stocks. But at the same time, you'll find the Coles, etc. Who have been also buying back, but the share price doesn't react. So, the one way I think about it is that the core business should be good enough to give you at least the return, which is GDP plus nominal GDP growth. That is something that you have to deliver. Otherwise there is no point. I mean, if there is a chance that your terminal value is actually under challenge, then there is actually no point in doing buyback. But in the case like you have a visibility that the business can actually grow at 6, 7, 8% at an organic level, then if you're doing buybacks, etc., that actually makes sense. And in fact, any company that you study, I mean, there has been, as I said, AutoZone, Orally, Murphy USA, those kind of companies which have been doing this kind of buyback, they're successful. But as I said, the companies that are not successful in doing that, I mean, they're doing buybacks, but the market doesn't reward them. The list is also quite large, right? So you have to be very careful. I mean, there is nothing, there is no blanket, it works for all.
Just to jump in here, the other side of capital allocation is also acquisitions. Now, in India, we have relatively few examples of companies which have done really well through acquisitions. But globally, there are quite a few more. There are companies which we have in our portfolio, like Danaher, for example, which has consistently reinvented itself through acquisitions, through consistently transforming its business. Now, that is also a form of capital allocation. It's rarer, but companies who do it well can reinvest a lot more for a lot longer and can keep their growth high using that method as well.
Got it. Fair enough. Mr. Parag is asking if 50-50 portfolio is available for Indian investor. So, sir, it's just a hypothetical portfolio that we have created to show and prove the point diversification makes a lot of sense. You can very well invest basis your overall portfolio. We are not recommending 50-50 or any such number. You have to take a calculated call. Minimum ticket size to invest in global compounders PMS through GIFT City is $150,000, which we expect, given that consultation paper is out, to be reduced to $75,000 in next couple of months. However, if you are an accredited investor, you can start your journey with as low as $25,000. And one of the questions that has been asked by Sohail is the definition of accredited investor. Accredited investor has to meet any one of the two criteria. The first is if your gross annual income last year was more than $200,000. That means your gross annual income last year should be more than 1.6 or around 1.7 crore, or your net worth, net assets should be at least $1 million, which is basically 8.5 crore, out of which 50% should be in financial products, which basically means around 4.5 crore you should have in financial products, which is like mutual fund, debts, in those kind of products. If you meet any one of the two criteria, you are an accredited investor and you can start investing journey with $25,000. The minimum criteria of $150,000 doesn't work, doesn't apply to you. Sakshi is asking if you can show the correlation of GCP and Nifty 50 portfolio, if you have handy, and if you can show GCP portfolio versus Nifty 50, in case we have.
No, I mean, we do not have that handy, but I think the S&P 500 and Nifty 50 correlation would be similar. I mean, it will not be too far from that.
Yeah, so if you can just beam up that slide, and we are happy to share the slide, Sakshi ji, if you can just drop us an email. In fact, anyone needs the slide, if you can drop us an email, invest@marcellus.in. You can CC me, Nitesh@marcellus.in, and we will be more than happy to share the slides. Naveenji is asking that 50-50 combo of S&P and Nifty 50 slide, the weighted average return is higher than individual. Is that a mistake?
So I'm assuming the 14.4 number?
Yes.
No, it is not a mistake. It's correct actually. So you typically get this is a typical benefit of diversification.
Absolutely.
Yeah.
So, because correlation is low on the upside, you're getting benefit and hence your average goes up, Naveenji.
So remember one thing that we are, so after every year, the way this has been constructed, so suppose you invested 100 rupees, like 50 to start with, then after 1 year, your money, it became say 120, and 120, the contributions becomes the India market does well, so the India part becomes 70, the US part becomes 50, it remains 50, it didn't do anything. But at the end of the year, you actually again rebalance it. You make it 60-60, right? So that is how you get into that 14.4.
Wow.
Rebalancing every year.
Rupam has a specific question on one of our portfolio company, IDEX, on their buyback activity. He says that buyback is happening at a very high price. IDEX, for example, has accelerated their buyback in 21-22, spending more than their operating cash flow for buyback. Is it detrimental to shareholder in long term?
So if I look at the buyback, the timing of the buyback, when what they have done, I think it is actually fairly okay. I mean, to me, the fair valuation of this company is somewhere between say 25 to 30 times in terms of EBITDA. This company can actually grow at around 11-12% top line, 15-16% at EBITDA level, right? And with deploying very limited amount of capital. So when I look at their buybacks that they have done, if you can just plot the average price at what the quarters they have actually mentioned have done the buybacks, they've actually timed it reasonably well. And as I said, the company's growth runway is actually pretty strong. Had they did the buyback they started doing, I mean, aggressive buyback if they're done in 2021 peak, then probably I would have been more worried. They didn't do it. The recent quarters they've been doing it, which is fair. I mean, I would say given the price point they're at, it is actually below fair value in my view.
Got it. Fair enough. One of the queries is on inheritance tax. Yes, there is an inheritance tax. If you are not a US resident, and hence, we always recommend a person to open a joint account. We are happy to share more information if you can just drop us an email, invest@marcellus.in, and we will share you more details about it. Arunji is asking, is this global portfolio includes European or any other emerging market?
It's actually a developed market portfolio, so you do not have any emerging market. It is we're looking at broadly the stocks listed in US and developed Europe. US,
So
Canada,
75.
yeah,
Yes,
US,
sir.
Canada, and developed Europe. Allocation wise, it will be around 80 to 85% would be in North America, which is basically US and Canada. The balance would be in UK plus other European countries.
So nothing in emerging market, Arunji.
No, nothing in emerging markets.
Fair enough. I think if anyone has any queries, please feel free to type and we will try to pick it up.
I mean, India is the best emerging market, to be very honest. So in that sense.
So one query is on Nvidia. You don't have it in a portfolio. Do you think it was a miss? And even though it corrected 30% in the last 1 month, but you think you missed that Nvidia rally?
Yes, it is a miss. We fundamentally, I mean, we looked into it actually, I think almost 1.5 years back, and we didn't anticipate the massive adoption of or the pickup in AI. So definitely it was a miss. Now it corrected, I mean, as you mentioned, from 140 to it came down to I think 98, 99 or 100, something like that. Again, so at this point of time, we looked into it, but we are probably not chasing it, to be very honest. Um, so again, the franchise is superb. The moat, as Javid mentioned, it's a software and hardware-driven mode, so not that easy. Right? It's not a Cisco of 2000. But at the same time, probably we are running into a situation where if I even look at the forward numbers, not this year, say for example FY25 or FY26 revenue numbers, if it suppose it goes back to its previous high, like 135 or 140, you would be probably paying around 20 times, actually more than 20 times price to sales. Now that multiple, so we're kind of paying 20 times sales, which is kind of a peakish multiple on a potentially peak growth and potentially peak margin. Now again, we don't know. It might continue to surprise, but in that setup, in my view, in our view, it is the margin of safety is actually quite low. And one thing that we tend to forget is that these are typically cyclical stocks. When there is a secular run, bull run, we forget that these are actually cyclical stocks. So again, we missed it. Chasing it this point of time, probably do not find too much of rational. But again, if it corrects significantly, and we find we're at the good point of the cycle, we'll definitely worth the visit. Jabir, you want to add anything?
I think you covered it well. Cyclicality is like it's a fact of life in any semi stock. Same thing for Nvidia, and in fact, historically, it's been a little worse for Nvidia. Late in the cycle, anything in semis, we'd be hesitant.
Fair enough. One of the queries is, what is the timeline for allocating fund if invested today? Correct me if I'm wrong, Arindam, we don't try to time the market. We deploy it, as soon as possible. A minimum ticket size, if you are a non-accredited investor, it's $150,000, which we expect will come down to $75,000 in next couple of months. A minimum ticket size is $25,000 if you are an accredited investor, and minimum top-up amount is $5,000. If you're an accredited investor, you can start with as low as $25,000, and you can top up $5,000 as and when you feel comfortable. Sajiji is asking a question: if is a joint account with $75,000 eligible to invest in GCP? $75,000 as of now, no. Minimum ticket size is $150,000. But as I mentioned, we expect it to come down to $75,000. Consultation paper is already out. And we are hopeful in next couple of months, it will come down to $75,000. But if you are an accredited investor, Sajiji, yes, you can start with $75,000 in joint account name. I think we have covered all the queries. I think that's it. Thank you so much, ladies and gentlemen, for taking out time and joining the call. If we have missed anything or if you have any further queries, I will request you to please drop us an email, invest@marcellus.in. And you can CC me in Nitesh, NITESH @marcellus.in, and we will revert back to you. Thank you so much. Thank you, Javid. Thank you, Arindam.
Thank you.
Naren.
Thank you.